Hi there, it's Bill with Smart Trades, and it's Sunday, September 6th, around 3:35 p.m. Pacific time. And today I wanted to take a look at kind of a non-Elliott view of gold and silver, nonetheless kind of a fractal set of formations that I'd like to compare. And I'll bring your attention first to this somewhat of a wedge formation that we've got on the short term from the July lows or so. And from there also going back to early 2010, late 2009, we have a wedge type pattern as well, connecting the highs and the lows. So I think that's interesting. These two upper channels are going to come together around the 1282, 1283 area. Let me show you as well. This is the longer term chart yet, and this is looking at the highs from 2008 and the lows from 2009 and connecting those to the more recent highs and lows. And as you can see, that's a bit of a wedge formation as well. I'll pull them all together here, and you can see that this area, approximately 1280 up to about 1300 is the top of all three wedges. Now, if the market were to keel over from that area, I think that would be a significant and potentially, both a short-term and a longer-term change in trend. So, worth watching here over the next several weeks. Here is silver. We have a similar pattern there as well. We have just above the market right now, just above the 20 area, we have indeed the top of yet another wedge. So, and note here the volume is declining. Some of that is typical summer volume, but nonetheless, I think this is a significant drop in volume, and it does help to confirm those wedge patterns. I'll skip ahead here to the S&P and to quickly update what I talked about last week. We have a possible 5 waves up with an extended 5th wave here. I mentioned that we're likely to see a new high before we went lower. I suspect that that's still the case. We may have just a little bit more upside, but if we were to lose momentum and start heading lower, I would think about shorting, given the potential longer-term bearish scenario and the fact that we're probably going to head down a good 15 points even in the most, or more like perhaps 25 points even in the most bullish scenario. So worth a shot there if we see it roll over. You have to be very nimble. You want to be watching it if you're going to take that kind of a trade, because the longer term I do believe is back up again, and I'll get to that in a minute. At any rate, here's the advanced decline line. It's showing lower peaks. And in the context of making some higher highs on the way up and higher lows. So I think that it's open for argument, but I think that the basic message is that the market is longer term going higher, but short term it's getting a bit vulnerable here. So first target is around 1076. That's the previous 4th wave low, and then down to about the 62% retracement level, which is also filling a gap, and the top of a previous resistance and support area around 1065. That's basis the S&P cash. Now here's the bigger picture, and again I've gone over this several times over the past few weeks or months, and just to put it into perspective, although I'm short-term bullish here as long as we hold these recent lows, this is in the spiders. I'm labeling this B. Longer term, I think that we're eventually going to actually take out the July lows. So we shall see, but I think this is the best resolution of this pattern. I think you've got a corrective pattern down. We've got a corrective pattern working its way back up, but I don't believe it's complete. And let's take a look at the S&P cash targets. They're going to come in around that 1157 area, all the way up to the April highs, which are around the 1220 area, basis the S&P cash. And again, I see this in the context of a larger correction. So up to the 1160, possibly 1220 area. It's far too early to tell. We'll try to resolve that as we get a little closer. And then down perhaps to the 950, 960 area. Certainly I would expect it to take out, again, that late June, early July low, if indeed this count is correct. And finally, here's the really big picture. And to put this whole thing into context, I'm counting this entire decline to the 2009 lows as an ABC of A, that the rally back up is basically a corrective B wave. So within that context, we've got a B wave within a B wave within a B wave. And that explains to some extent all the confusion with these patterns, because B waves are the most unpredictable pattern in the Elliott wave universe. And we shall see here. Obviously, if we start cutting through the lows, perhaps around that 950, 940 level, basis the S&P cash, there's a good chance that it's a much more bearish pattern. But for now, this is my working pattern. We'll see how it goes. And have a great week ahead. Thanks for watching. Bye-bye.